These are my top 9 stocks to buy right now. We'll go over one stock that I own, followed by one new stock to keep it interesting as we alternate our way up to a stock that's increased 50% in the past month, but may be ready to double again. As always, we'll start by putting my money where my mouth is by showing you my actual stock account. As you can see, my total account value is just under $200,000, and over the past 1 month, it's increased by about 6.7%. But if we zoom out a little bit, year to date, or at least over the last 3 months, it's actually down a little bit. But then if we zoom out even more, it's actually up over 27% over the past 6 months, which just goes to show that investing in these types of stocks can be very risky, but it can also be very high reward. So as we go through each of these stocks, I'll also show you exactly how much money I have invested in each one. Starting with stock number 1. This is a company that is accelerating their product growth, continually adding new members, and basically dominating the fintech space. SoFi is basically 3 businesses in one. They run their SoFi app and financial services, which then drive traffic to their incredibly profitable lending business. And to support their rapidly growing business, SoFi runs their own technology backbone, which they've started selling to other businesses. So before I show you how much money I have invested in this stock, let me walk through the 3 main reasons that I'm investing in SoFi. Reason number 1, they are growing like crazy. I mentioned that lending is the most profitable area of the company, and it's been around for a long time, and yet this segment of the business is still growing over 20% per year while churning out tons of profit for the company. And on top of that, they built their financial services segment where they sell things like the SoFi app, the SoFi credit card, and SoFi Money. This segment is growing even faster, growing as high as 100% in some quarters and 42% in the most recent quarter. And the fact that they have this massive growth engine driving the business is the reason why their number of members has increased so much, with 622,000 members in just the last 3 months. But just adding members by itself isn't that valuable. They're only valuable if they can then turn those members into a profit, which is where SoFi's financial services productivity loop comes into play. This is a core part of SoFi's strategy, and on this slide they make it look more like a funnel, but basically the idea is as SoFi sells new cheap customers onto things like the SoFi app, they can then funnel them into more valuable areas of the company like lending. And as they get more and more customers, they get more data which they can use to improve their technology platform that they can then sell to other companies. You may have heard of the Robinhood investing app, which is a competitor to SoFi. Well, they're also SoFi's customer because Robinhood runs their checking and savings account on top of SoFi's platform, which leads us to reason number 2 for investing in SoFi. They're actually a pretty good value. Now hold on, you might say, this stock is down 25% year to date, and they don't even have a PE ratio because they're not technically profitable yet. So how are they worth $7 billion? Well, because the company is aggressively investing in growth right now, they're more focused on growing than becoming profitable. At the same time, the company does have a clear path to growth, so this isn't just a story the CEO is telling. If we dive into the company's financials, and don't worry, we're not going to get too deep here, we can see SoFi breaks out each of those 3 main businesses, lending, technology platform, and financial services separately. And they call out one number that I want to show here, which is the contribution profit. We can see that for financial services, in the past, they've actually had a negative profit, meaning they've been losing money in this area. But in their most recent quarters, the company now has a positive contribution profit from this segment. And it's the true for all the other segments as well. Technology platform makes a profit, and of course, lending makes a huge profit. Now, the overall company still has extra expenses that they have to catch up to, but what this means is that as each segment grows and that financial services productivity loop runs, SoFi will become more and more profitable over time, until eventually they hit the level where that profitability just grows by itself. But that's not even the biggest reason that I invest in SoFi. The third and final reason that I bought this stock is they are the kings of change. Not only did the company weather a contentious breakup with their former CEO and one of those founders, I'll be doing a separate deep dive video on SoFi that goes more into that, so make sure you're subscribed for that. But the company has basically worked under 3 different business models in just the last decade. They started out as a student loan company, offering student loans across the country. Then, as Anthony Noto, the current CEO, came along, they began having a broader focus on consumer fintech, building things like the SoFi app and the SoFi credit card. They were now building an ecosystem where each product makes every other product more valuable. But even more recently, they've had another change, which a lot of people aren't talking about. And that was SoFi acquiring the firm Technisys as well as the Galileo payment software, allowing them to build their technology platform. And more importantly, to start selling this platform to other businesses. Now SoFi was no longer focused only on selling products to end customers. They could make additional revenue by selling their services to other companies, which tends to be a much more stable business than interacting directly with consumers, especially in the investing space. And so with that solid growth rate, honestly pretty decent numbers behind the company, and their ability to quickly pivot when anything comes up, it makes me pretty confident in SoFi's future, which is why I currently own 2,230 shares in this company valued at $16,000, and that's made me around $1,600 overall. Oh, and by the way, Charles Schwab puts these ratings on stocks. As far as I can tell, it's like a valuation rating, because I've owned stocks that had an F rating for 2 years that made a 300% return, and they had a bad rating the whole time, so I don't put a ton of stock into those. But okay, that's one stock down, SoFi. But now let's move to my biggest investment in one of the most important technologies in the world, data. As British mathematician Clive Humby said, data is the new oil. If we think about what oil did to the world economy back in the early 1900s, it's hard to overstate its importance. Oil is what ran the engines of industry that built the modern world that we have today. It was coursing through the very veins of society. But now we have a new form of oil, which is data, which courses through the veins of the internet. The more data you have, the more valuable the data becomes. This is why massive companies like Google and Meta are hoovering up all the data that they can, because with data you can create AI models, you can predict customer trends, and you can sell more products. And so I invested in a company that makes it easier for other companies to use their own data. What they do is make it so any business can see their applications, their infrastructure, and their security all through what they call a single pane of glass, enabling companies to make better decisions in real time based on what's happening in the company. And that company is Datadog. So here are 3 hard-hitting points in favor of this stock. Number 1 is data and AI. Generative AI models like ChatGPT are now becoming more commoditized. Basically, everybody has access to these models. And so what becomes important is, what do you do with these models? Well, in companies that have well-organized data, they are able to massively leverage AI in ways that other companies can't. And so even though Datadog isn't directly creating new AI models, they are enabling companies to use them more effectively. And so customers that are already using Datadog are going to move faster into AI, and customers that aren't using AI are probably going to need a platform like Datadog to even get started down that road. And so as data and AI, these twin investing trends, drive forward, those are going to drive Datadog as well. Number 2, Datadog is a B2B focused company. A lot of companies in the AI space talk about how it's going to affect consumers, but the first movers in this space are going to be large enterprises, like the companies that Datadog tends to interact with. And like I mentioned with SoFi, being in the B2B business tends to be a little bit more stable than trying to sell directly to consumers. And it gives them an opportunity to land on a customer and then expand over time. We can see Datadog started out as a real-time unified data platform, and they've launched new products that continue to build on each other over time. Nowadays, most of their customers use multiple products, which means every new customer they add is more valuable today than they were when Datadog started. And so the metric I'll focus on for this company is their dollar-based net retention rate, which has been over 100% as long as this company's been around. So basically, for every dollar a customer spends this year, they can expect them to spend $1.10 next year. And that's just built-in growth to the company, even if they don't do any marketing. Which rolls us into the third point in favor of Datadog. The overall market that they are in is rapidly expanding. The data market is expected to grow at a compound annual growth rate of 13% over the next 8 years. And so that's if Datadog doesn't even move and just rides the market, they get that 13% growth. But of course, this company blows that number out of the water, with the company growing their revenue 26% in the most recent quarter while making almost $2.5 billion in revenue per year. And that's not a one-time thing. They've had that high growth rate basically as long as they've been around, which is why I currently own 146 shares in this company, currently valued at $17,500. But now let's pivot away from my current stocks to a brand new stock that I've never talked about before on this channel, but it's one that Warren Buffett has been secretly buying up in droves. And by the way, I've been getting tons of messages on Instagram about fake accounts messaging them, trying to get them to buy crypto or something. So first off, I'm never going to message you on Instagram asking you to invest in some kind of crypto. And if you ever receive one of those messages, just make sure to delete it and report the account. And that's partly my fault because I haven't focused a lot on Instagram. And so a lot of these scam accounts actually have more followers than I do on my Instagram. So it's pretty easy to see why some people might be getting confused. And so instead of having a sponsor in this video, I'm just going to link my Instagram account in the description instead. So if you want to follow me, it'll help make the scammers look less legit. Hopefully people will be less confused once my account has more followers followers than the scammers. And I've also been posting on there multiple times per week. And starting this week, I'm also going to start posting in real time my thoughts on companies' earnings that are coming out, as well as stocks that I'm considering investing in. So this is my Instagram on screen. If you feel like following me, I'd appreciate it, and maybe you'll help someone else out too. But let's now look at that stock that Warren Buffett has been secretly buying up in one of his favorite industries to invest in. Probably because companies in this industry tend to last hundreds of years and never go bankrupt. And that is an insurance company called Chubb. Warren Buffett's Berkshire Hathaway now has a stake in the company worth $6.7 billion, which makes it their 9th biggest holding overall. And he's been keeping it secret up until now, which seems like it was for a good reason, because as soon as it was revealed that this is the stock that Warren Buffett's been buying up, the stock price increased 8.34% in a single day. But even though the stock is up 36.7% over the past year, here's why the stock might still be a good value at its current price. First off, the company operates in the insurance space, which traditionally is one of the most stable industries in the entire world, because basically, they're just selling math. They just calculate the risk that they need to pay something out versus the risk of something happening, and as long as those two numbers have a gap between them, the company makes money. Now, Warren Buffett has a ton of good quotes, but I think this one is extremely applicable to this stock. He defines what a company is worth, its intrinsic value, as effectively the value of all the cash that can be taken out of the business over its entire lifetime. So when we're looking at a Warren Buffett stock, cash is one of the things we want to look at, and Chubb has a lot of it. The company reported in their first quarter that their net income per share was $5.23, with their core operating income at $5.41, meaning the majority of that operating income dropped to the bottom line. And that's an increase of 22.7% year over year, meaning this isn't just a stock that's completely static, it also has some growth behind it. The company currently has a PE ratio of 12.17, which is pretty low for the average in the market. Usually the market averages between 15 and 20, and it's been averaging on the higher end of that for the last couple years, which gives the company a current market cap of $111 billion, and it has a dividend of 1.25%. So this is kind of in contrast to a lot of these high-flying growth stocks that we're seeing. This is sort of a low-flying growth stock. It's relatively cheap, but it's also growing extremely quickly. You can see why it's attractive to someone like Warren Buffett. Now, is this stock going to triple or 4x in a couple years? Probably not. But if we just zoom out and look at this stock over a 5-year time horizon, pretty much the only really big drop they had was at the start of 2020. And other than that, they've had some short-term corrections, but the stock price has basically smoothly been rising. And so we'll see what happens to this stock next week and a few weeks after, once the news of Warren Buffett is started to settle down a little bit. But I would expect this stock to remain a solid grower going forward. But now let's move out of insurance and into a company that's growing faster than almost any other stock in one of the most important investing trends of the next decade: cybersecurity. Cyber attacks continue to increase in how often they happen, as well as how complex the attacks are. Just in 2024, we've seen the French state be DDoSed, basically bringing down their services. We saw the biggest health payment processor in the US be brought down by a ransomware attack. The UK Ministry of Defense was hacked, and the National Health Service in Scotland was hacked. It's pretty much impossible at this point to find someone who hasn't in some way been a victim of having their data leaked or a service that they use compromised by one of these cyber attacks. And as we see more democratization of information around the world, it becomes easier and easier to launch these kinds of hacks. And especially now with generative AI, we're even starting to see viruses that can change on the fly or be rapidly rewritten using the latest tools in generative AI. And so in order to combat that, you need to fight fire with fire, which is where my next investment comes in, which is CrowdStrike. CrowdStrike is an AI-powered cybersecurity company. Nowadays, most companies don't own the physical hardware where they actually run their website or the applications in their business. Most stuff is done on the cloud now, and as time goes on, more and more companies are moving into the cloud. That was kind of CrowdStrike's first claim to fame. They were a cloud-native cybersecurity company, and so they were better at protecting cloud workloads than pretty much anyone else. But nowadays, they're focused more on the fact that they are AI native. The company has long been known for their threat graph technology, where with traditional cybersecurity, you basically look at all the hacks that have ever happened, and when a new potential virus comes in, you compare that to all the previous hacks and see if it looks similar. The problem is, if there's a brand new attack that's never been done before, you're not going to catch that with those systems, which is where AI-powered cybersecurity comes in. Now, instead of needing to look exactly like a previous attack, we can build intelligence directly into the tools to recognize an attack that's never been seen before. You may remember the SolarWinds hack from a few years ago, which caused Microsoft to release this article saying saying that we were in a moment of reckoning in the global cybersecurity space, where they're starting to see things like attacks by nations with top-tier offensive capabilities. In fact, this hack was so effective that it hit the US Department of Defense and companies like Microsoft. But you know who wasn't affected by the SolarWinds breach? Customers who are using CrowdStrike's products. This goes to show how important data and AI are becoming in the cybersecurity space. And this is an area that has massive growth behind it currently and in the future, which is one of the reasons that a company that makes almost $1 billion in a single quarter is growing at over 32% per year while producing profit and net free cash flow. I've owned CrowdStrike for several years at this point, and it's my best performing stock ever. I think I'm at to like a 400% return over the lifetime that I've owned it, because I bought and sold it. But I currently own 100 shares in the company valued at $34,500, and that latest investment has made me $21,000, so it's more than a 100% return. And this is actually the stock I mentioned where Charles Schwab has always rated it poorly, even though it's made me a ton of money. And as I read out these stocks, hopefully this gives you a starting point to do your own research and decide if any of these investments look good for you. But now, let's move to a stock that's growing even faster than CrowdStrike, and it's another fintech stock that has nearly doubled in price over the past year, but may be getting ready to double again. If you had to guess, what is the fastest growing fintech market in the world? You might be tempted to say China, or maybe even the US. But Latin America puts all those other regions to shame when it comes to new fintech adoption and investment. And Brazil is by far the biggest player in that market. But this stock is by far leading the fintech charge in Brazil, boasting over 100 million members in their most recent earnings and adding 20 million new members in just the past year. That company is Nubank, and here are the two biggest opportunities for the company today. So first off, we can tell that Nubank is obviously growing incredibly quickly, but they're also hitting a point where they already have the majority of the adult population of Brazil on their platform, and 83% of those people are already active. And so in order to maintain their ridiculously high 64% growth rate year over year in terms of revenue, they need to start expanding in new ways. So the first opportunity is expanding their existing product suite. The company already has a lock on fintech customers, but like we saw with SoFi, you can often sell multiple products per customer. So they're launching credit cards, they have a shopping service, they have a mobile app. As the company becomes more and more embedded in the life of Brazilians, they need to continue to innovate and launch new products that make their lives more valuable. And because fintech is relatively new in the country, and the country is aggressively investing in this area, Nubank has one of the biggest opportunities of any company in the world in front of it to become the center of Brazilians' tech lives. I know that's not as common in the US, but in a lot of areas of the world, most people only use one app for everything they do. Think WeChat in China. And we can see this working out in their numbers. The number of active products that each of their customers use is now up to 4.1, and the average value of each of their customers has been increasing over time. But then there's the second opportunity for Nubank, which is to expand internationally. Nubank is obviously the winner in Brazil. They're going to be the biggest player there. But the next question is, how effectively will they be able to expand into other markets where they're not quite as native? The first country that Nubank has been focused on is Mexico, where they've now reached 7 million customers as of May of 2024. And their goal here is pretty simple. Number one, they need to understand the user in Mexico, and number two, they need to meet their needs. Nubank understands that every country is going to have different cultures and different things that are important to them. Now, we've seen in the past companies like Sea Limited in Southeast Asia struggle to expand outside of their market, where they weren't quite as aware of what people needed. But if Nubank is able to successfully move out of Brazil and into Mexico, it starts to open up the world stage, where they may eventually be able to compete in Europe, the United States, and beyond. And so the thesis for investing in Nubank is pretty simple. In the short term, they're just going to continue to dominate in Brazil and continue to expand their market there. And then in the long term, the real potential for the 2 or 3x in price is if they're able to successfully expand into Mexico and then other countries. Personally, I'm willing to bet on it with 1,200 shares invested in Nubank at a current value of $14,000. And that is up around $3,000 from where I first bought it. And I know some people in the comments are probably looking at some of this red in my portfolio, but don't worry, at the end of the video, I'll show you every stock that I currently own. But Nubank has been a solid grower lower in my portfolio for a while. So let's now turn to a stock that is likely to get a ton of attention over the next few months. So some context, the next crypto cycle has clearly kicked off, with Bitcoin increasing by 150% over the past year. But there's a big difference between this cycle and some of the cycles that we've seen before. There are ETFs in crypto now. Now, ETF stands for Exchange Traded Fund, which is basically a really cheap way for investing in a basket of stocks normally. But now, with different regulations in place, they're actually allowed to create ETFs specifically of Bitcoin, meaning you no longer have to either manage the Bitcoin yourself or invest through an app which has the potential to go bankrupt and lose all your money. You can just buy an ETF instead. Now, there are a lot of options when it comes to investing in a Bitcoin or Ethereum ETF, which are the two biggest cryptos. But of the options that are out there, my pick is EZBC from Franklin Templeton. There's a couple reasons for this. Number one, this ETF has by far the lowest fees that I've seen, with a fee of 0.19% per year, and that fee is waived until August 2nd, 2024, or until that ETF reaches $10 billion in fund assets. And as we can see, if we go to the page for this ETF, the company currently has a portfolio that's valued at $411 million. So they're not going to hit $10 billion anytime soon, which means you're basically getting to invest in the ETF for free probably until around August. Now, to be fair, while that fee is quite a bit lower from a lot of other ETFs in the Bitcoin space, it is still higher than the average we see for something in, say, the overall stock market. VT Sachs is the ETF that I like to use to invest in the overall stock market, and they have a way lower expense ratio, averaging 0.04%, so what, 1/5 as much as the Bitcoin ETFs. But as more and more ETFs get approved, there's going to be more and more competition in the space, and so these fees are going to get pushed down over time. Now, quick side note, there's a big difference between investing in a Bitcoin ETF and investing in a Bitcoin strategy ETF. So here's the difference. Bitcoin strategy is investing in areas that are connected to Bitcoin, but not the core Bitcoin itself. So for example, this ETF is investing in Bitcoin futures. This one invests in Bitcoin mining stocks. This one invests in a mix of Bitcoin and Ethereum futures. And so these strategy ETFs will tend to have higher overall fees, and they're not going to be directly correlated with the price of Bitcoin, while investing in a Bitcoin ETF should exactly match the price of Bitcoin. But now that we have our crypto itch scratched, let's look at one of my favorite stocks in the entire stock market. So for this one, let's start with a question. What is the internet worth? Not the stuff that's on the internet, not all the data that's there, but the actual core technology that runs the internet itself. Well, if you really think about it, the internet is really built on 1980s technology that we've kind of slowly globbed onto over time to try to make it better. But with all these unplanned changes over time, it's become extremely inefficient. So this next stock is attempting to change the way the internet itself works. Cloudflare. Now, Cloudflare is building what they call the connectivity cloud. Their goal is to make all aspects of the internet closer together in time. The company started out just hosting people's websites. Then they started building firewalls to protect those websites. And so to do that, they had to analyze all the traffic going in and out. But then they realized if they're already looking at all this traffic and trying to block bad actors, why not use that same information to optimize the experience for good actors? And off of that core realization, Cloudflare was off to the races. This may be the most innovative company in my portfolio. They've expanded from just having application security and performance to adding network features, developer features. They've even expanded into zero trust recently. So here are my three main reasons for investing in this company. Number one is the company's extremely solid growth rate. The company made $370 million in revenue in their most recent quarter, and they're growing at 30% per year. And the growth has been pretty rock solid over the past decade. The company has also promised to 5x their revenue over the next 5 years. And while the company is not yet profitable according to GAAP accounting standards, their profitability is improving over time, and maybe even more importantly, they are free cash flow positive. And when it comes to growing businesses, in my opinion, cash is a lot more important than profit. With cash, you can invest back into the business. You can buy back the stock if it drops. You can buy up a competitor. While profit can often only appear on paper, and it doesn't really do anything for your business, which is why Warren Buffett likes to look at discounted cash flow as his valuation metric. And so the combination of free cash flow and continued willingness to invest back into the business is my second reason for investing in the stock. And then reason number three is the company moving into a new area, zero trust security. With traditional security, you basically build your firewall around your network to keep all the bad guys out. But if they somehow get into the network, they now have free reign to access everything. And And if Cloudflare's goal is to connect the entire internet closer than ever, that means you need to protect every computer, every person, every application on the network. And they do this using zero trust, so that every one of those people has to authenticate anytime they talk to someone else. And to really simplify, basically this is the way that all security is growing, especially as more things move into the cloud. And another stock that I invest in, Zscaler, does something similar, but Cloudflare may have an advantage here since they're also building the network itself that connects the internet. And so based on those three factors, I've bought 162 shares in the company, currently valued at $12,000. And that is up around $1,400 since I bought it. But after Cloudflare, let's move to a company that's added over $500 billion to its market cap over the past year, but still looks cheap relative to its competitors. And that company is Google. Google has traditionally been the leader in AI technology. That is, until ChatGPT came onto the scene and completely stole their thunder a couple years ago. Since that time, Microsoft, one of their biggest competitors, has hit a market cap of $3.12 trillion, partially driven by their 30% ownership in OpenAI, the creators of ChatGPT. This also made Microsoft have a PE ratio of 36 versus Google's PE ratio of 27, meaning Microsoft is more expensive than Google. So the question then is Google too far behind in AI to catch up, or do they have something up their sleeves? Well, Google recently had their Google I/O conference, which is a conference for developers using Google's platform. One of the biggest businesses in the world right now is the cloud computing space, which Google competes in, Amazon competes in, and Microsoft competes in. Amazon with AWS was the first one in this market, and they completely dominate it for traditional companies. But for a lot of companies that now want to use generative AI, they've been looking at Azure due to their deep integration with OpenAI, the creators of ChatGPT, which is interesting because traditionally Google has been known as the leader in the AI space for cloud. And while they did fall behind ChatGPT, I think that they're actually not as far behind as a lot of people think. Google recently has launched their Gemini model of generative AI, which is basically the ChatGPT killer. These models are insane. I used them in my previous video where I made an AI that trades stocks for me, but Gemini was a multimodal model that can read in images, learn text, listen to audio, and generate things in all these different formats. Now, of course, ChatGPT has responded by launching GPT-4o, which can also process audio, vision, and text in real time. But the big thing here is that Google and ChatGPT are now launching products at around the same time, where Google used to be around a year behind them. This means that fundamentally, Google is catching up to Microsoft in the AI space. And are they going to pass them this year or next year? I don't know. But it seems like if this trend continues, they are going to pass them at some point. And when this happens, Google Cloud may take its place as the default platform for anyone who wants to build using AI, knocking Microsoft off and relegating them to companies that want to integrate with Microsoft Teams. There's a million, honestly crazy use cases that I can find on Google's website where they talk about the things people are doing with AI. Honestly, a lot of it feels like stuff that would be 10 years in the future, but it's happening right now. And so because of that, I'm extremely bullish on Google. I think that realistically, they will be valued very similarly to Microsoft, if not even more than Microsoft at some point in the future. And so because of that, I've bought 123 shares in a company now worth over $21,000, but I only invested 16, which means this stock has made me $5,500, and it's my second most profitable investment, which is crazy because I've only owned this stock for a couple months. But now let's turn to another new stock, which is one of the most interesting companies in the world that just recently went public. Now, I've been talking about data a lot in this video, but data is only useful when you also have computing combined with it. Now, platforms like Microsoft Azure and Google Cloud will provide the computing for you. You just have to pay for it. And so there's kind of been this balance recently in the AI space between what's more important. Do you just throw a bunch more computers at the problem to make the AI better, or do you throw a bunch more data at it to make it better? What we're seeing now is more and more of these AI companies, instead of launching more powerful AIs, are actually launching smaller and more lightweight AI models. And so that seems to be a point in favor of data over compute. But if data becomes more important, then it becomes important to understand the different types of data. There's super organized data, which is the type that Datadog is really good at, where you get all your data into nice dashboards and you can feed it into a bunch of different systems. But then there's unstructured data. This is more like what you might find on Twitter. It's just people blasting their thoughts out into the world, and they're not organized into databases and tables in an easy way to process. And generative AI has use cases for both of these types of data. But more and more, we're seeing generative AI focus on human-like conversation. conversations. It's not enough to just understand what you said. It's important for it to respond back to you in a way that feels like a human. That was a big feature of OpenAI's recent announcement of GPT-4o and how their different AIs could talk to each other. But where do you get the data to teach an AI how to talk like a human? You could use Twitter, I guess, but those aren't very human conversations, at least not the type that I have. They're more of declarations into the void of what you believe. And so this is where my last top stock comes in. Now, this is a company that's not doing that great in terms of earnings. They are growing relatively quickly at 48% with around $1 billion in yearly revenue, but they only have a little bit of free cash flow, and they were actually losing money in their most recent quarter. But this is a company that is betting on the future of conversation-driven AI, and that stock is Reddit. Right now, all the AI companies are jockeying for Reddit's data because Reddit conversations are much more like human conversations than what you see on Twitter. The entire platform is designed around people commenting and replying to each other. And this is just better data for training an AI for, like, I don't know, become a sarcastic chatbot.
Hey, let's have some fun. I'd like you to be super sarcastic.
Oh, that sounds just amazing.
I don't currently own Reddit stock, but I promised I would show you my entire current stock portfolio, so here it is on screen. Make sure to follow me on Instagram for all my latest thoughts on the stock market, and Google's AI thinks that you'll really enjoy this video next. That's what it says.